QYLD. It's a monthly paying dividend with an incredible 12% yield, but is it worth investing in? Well, welcome back to the channel. If you are new to investing, there is a lot to understand between growth and income. And QYLD may or may not fit into your investing strategy. So today I'm going to break down the facts so you can weigh and judge your best options when it comes down to this ETF. Now, the goal of QYLD is to pay monthly dividends. And it's been doing so consistently for the last 7 years, which is a great sign. And at the recording of this video, it's roughly right around 19 to 22 cents per share every single month. What that means is if you would invest $10,000 into QYLD right now, you would make roughly around $1,189 a year, or just under $100 per month in monthly payouts. And the best part is, you buy another share, you give yourself a little raise. You buy 2 more shares, you give yourself even more of a raise. That's the beauty of dividend investing. So in a recent community poll, I asked, what did you guys want to see next? And QYLD was the winner. So that's what we're talking about today. In this video, we're going to break down, number 1, the QYLD portfolio and why it might be a little bit different. Number 2, we're going to talk about the covered call option strategy that QYLD uses in order to pay you every single month. It's a little bit different than your typical dividend paying ETF. Number 3, we've got to review taxes because it's very important. There are some tax interesting things when it comes down to QYLD that you need to know, as well as review return of capital that this particular ETF sometimes uses. Last but not least, number 4, there's a little bit of a warning between growth versus income, and is QYLD worth investing in? And we're going to talk about an alternative that might be a little bit better. So you ready to get started? Well then, don't be dumb, tap the thumb, and let's get going with the video. First up on deck, let's talk about the QYLD portfolio. Now this one is interesting because it tracks an index of the NASDAQ 100. So they have 100 of the largest domestic and international growth companies, and they rank them based on market cap. So really the goal there is all about growth, and that's what innovators like to do. They want to continue to grow and grow and grow. And oftentimes they don't pay the best dividends because they take a lot of their profits and they reinvest it back in the company so they can continue to innovate. And that's kind of obvious when you think about things like Tesla and you think about things like Apple. So a great way to invest in the NASDAQ 100 beyond QYLD is ticker symbol QQQ. I've actually talked about this ETF on another video, but QQQ is focused specifically on growth. So the dividend yield really isn't all that exciting. But the key difference here is that because we focus on high growth companies that pay little to no dividends, something like QQQ would be more attractive to a growth investor instead of an income or a dividend investor. And that's where QYLD, the topic of today's video, comes in. So they use an option strategy. They use a covered call option strategy to take advantage of these high growth companies in order to pay a consistent monthly dividend to its shareholders. And that brings us to number 2. What the heck is the covered call option strategy? How does that actually work? So covered calls are an option trading strategy that helps provide people income based upon stocks that typically don't pay you income except for when you sell them based on their growth over the long period of time. Now, I think it's very important to understand this covered call strategy before you invest into QYLD, and that's why I want to share it in today's video, just so you have a basic understanding of how this works, so that way you can understand what QYLD is doing as you ride the roller coaster with this particular ETF. Now, I'm going to break it down as if it's just you and I. We're individuals and we want to trade in the covered call option strategy. Here's what we're going to do, and what I'll do is I'm going to actually use my Robinhood account to trade this covered call. I'm going to start with a company that is actually in the NASDAQ 100, and that is our buddy Tesla. So you can see right here the share price currently for Tesla is sitting at $661.40. Now there is a lot of volatility when it comes down to Tesla. Something big could come out tomorrow in the news and it could shoot up to the moon. It could go up to like $1,000. But because of that high volatility, the premiums that people pay for these particular options can be quite high. So here's an example. Let's say I want to do a covered call of $670. You see it says $670 call, and then there's a number that says $16.78. That number is the premium. Now, in order to trade a covered call, you must own at least 100 shares of the company. So for me to even do this particular option, I would have to own at least 100 shares of Tesla. Let's say that I do. What I would want to say is by July 30th, and right now it is July 26th. Over the next couple of days, my thought is between now and July 30th, I will give you the option to buy 100 shares of my Tesla stock if it hits $670 or more. But because of that, you want to buy into that option, which means the premium, you're going to pay me $16.78 per share for the option to buy my 100 shares at $670 if it hits that amount. So check out what happens here. If I want to sell this call, I'm going to hit 1. That's 1 meaning 100 shares of my Tesla stock, which means my maximum profit could be $1,720. Now, what I want to have happen in this case, trying to make this as easy as I can for beginners, I want to make sure that it actually doesn't go up to $670. I want it to be at $670 or below. Because what happens is on July 30th, which was that expiration date, that means this option is kind of worthless. It just expires and moves on with its life, which means I get to pocket the $1,720 and I keep my 100 shares of Tesla. How awesome is that? But here's where things get bad. If, for example, it goes up to 671 or 680 or something like that, well, sure, I'll get my $1,720, but all my 100 shares of Tesla goes away because you exercise your right to buy the option, because that's what we agreed on right here. So you take my 100 shares at $670, I get my $1,720, which is okay, but I don't get to keep those 100 shares. So let's say it keeps going up. It's not just $670. Let's say it goes up to $1,000. Okay, sure, I got $1,720, but if the share price is $1,000, I'm losing out on major growth. Dang it. So what we want in a covered call option strategy is we actually want the market to be kind of flat or actually going down a little bit. And when it does that, if Tesla would go down or if it would stay the same, I get to keep my shares, while at the same time, I get to add an additional $1,700 into my worth. That's what I want. So that's the most basic form of what a covered call is. But how does that work with QYLD and what they're doing within their particular ETF strategy? Well, in QYLD's case, it's a little bit different because what they're doing is they're buying the NASDAQ 100 index and they're selling an index option. So it's a little bit different, but here's how it would work. Every single month, here's exactly what QYLD does. Month in and month out so that they can pay you your dividends. First, they sell a NASDAQ 100 index option to a counterparty that expires exactly in 1 month. A premium, just like we saw on our Tesla example, is then received in exchange for the sale of the index option. At the end of the month, QYLD aims to distribute a portion of the income generated from the writing and selling of the covered calls to the ETF shareholders. So that is very similar to what we saw there. Let's say we got $1,700 and I have that $1,700 that I earned from Tesla and I distribute it to shareholders if I was an ETF. That's ultimately what QYLD is doing, only it's an index option. Here's where things get better. There's a little bit more protection when it comes down to QYLD. With an index option, that right to exercise only happens on the expiration date at the end of the month. So in our example, right now it's July 26th. I had an expiration in Tesla set for July 30th. If at any point between the 26th to the 30th, that share price hits $670 or more, they can exercise the right to buy my 100 shares of Tesla. But it's not the case in this index option. It can only happen on the day of the expiration. So let's say it's at the end of the month, July 31st or something like that. Well, that means that it could go up to the strike price on like July 28th, but it could then fall back down below it on July 30th. And because it's down below it on the last day of the month, guess what happens? They don't exercise the right to buy. So QYLD gets to keep that premium and they distribute that money to all of us as shareholders in the form of dividends. What happens though if it does hit the strike price on the expiration day? Do they have to sell their 100 shares of Tesla or however many shares they own? Not really. They actually settle it in cash. So they settle it with their existing capital so that way they can keep their underlying securities. So all in all, QYLD continues to pay out those dividends at only $22 a share, give or take, at a 12% yield. 20 cents per share is really good. That is a really good payout every single month. But with all of that covered call writing stuff, that takes a lot of work, right? Well, because you have an active fund manager doing all of that month in and month out, there is a little bit of a higher expense ratio. Now, you may remember from my videos, I like to look for ETFs that have expense ratios less than 0.45%. Well, this one actually fails that, and the only reason why is because this one's not passive. This was an actively managed account. Somebody's actually going in there and trading the options, similar to the example I shared with you a little bit earlier. So because of that, this expense ratio is 0.60% for QYLD. That basically means for every $10,000 that you invest, it's about $60 in fees. But beyond all that, there's something else we need to consider, and that is the taxes that can come with something like this. This is a little bit of a different ETF. So what happens with the taxes? So the potential tax liability could actually eat into your earnings. So it's really important to understand what the taxes are all about when it comes down to this particular ETF. So anytime that they make money on premiums based on their covered call writing, those premiums are taxed at a rate to you, the shareholder, at 60% long-term capital gains and 40% short-term capital gains. Now, you don't have to track this and really understand it. It's a lot of math. You don't have to worry about all of that necessarily, because remember, at the end of the year, your brokerage firm will give you a Form 1099-DIV, and your QYLD earnings will be indicated on that 1099. You simply take that to your tax person, and then they can file it for you. But just keep in mind, based on your tax situation and your current tax bracket, based on your overall income, that 60% and 40% split, based on the payouts of the premiums, could get very interesting. But wait, there's more. There's something really important that we need to understand, and that is something QYLD has been doing called return of capital. Return of capital is a little bit different than the premiums that we just talked about. Because the market has been bullish and all of that money keeps going up. Like, for example, in the Tesla case, our $670 could easily be met. So in that case, you actually don't want that when it comes down to these covered calls. You don't want the price to go up because a lot of people could exercise those options and buy those shares or have QYLD pay out those cash securities. We don't want that. But in a bullish market, what happens is because they don't make a lot of premiums based on these option writing contracts, they have to still commit to wanting to pay you every single month because that's their business strategy. And as a result of that, they do return of capital. What return of capital is that they're basically taking the money that you already invested and they're redistributing that money to you in the form of a dividend. Now, how that works is really interesting. What they do is, let's say, for example, you bought QYLD at a share price of $22.50. As the months and the years tick by and you hold on to QYLD, the return of capital brings down your average share price, your average cost, to $21.50. Now that considers that you don't buy any more shares of QYLD in the process. And keep in mind, this is only an example. But because they're returning that capital to you as a return of capital, you actually don't have to pay taxes on those particular distributions because you're basically getting your money back. It's almost like a weird way of saying this is a refund because we weren't able to make you money on our covered call option strategy. So we're going to return some of your money to you, bring down your overall cost per share. Now keep in mind, you'll still have the amount of shares you bought. It's just the price that you paid will go down because they paid you back. But one important thing to keep in mind is because your average share price goes down, as I mentioned previously, this means the earnings are tax deferred. Now, this is okay for the time being, but you got to keep in mind that let's say a year from now, 2 years from now, or whatever it is, you decide you want to sell your shares of QYLD. Well, at that point, anything that was return of capital that lowered your share price will be then taxed, typically at then a long-term capital gain. So keep that in mind that if they continue to do a lot of return of capital because of this bullish market, you may end up paying a lot of taxes when you go to sell QYLD. Okay, now we got to bring up the warning. There's a big warning between growth and income. Is QYLD a good investment? And is there an alternative? So I'm really excited to share this part with you. Remember the goal. QYLD wants to provide you with high income every month. That is their goal. So that's great for you. If you're focused on building an income portfolio, maybe you're close to retirement, or you want to just maybe park some cash, some extra cash that you have around, and you want to park it into something like QYLD and earn some extra money. It sure beats bank savings rates, right? So that's a great way to park some cash. Now, I do got to say, really quick disclaimer, I would never recommend that you actually put your emergency fund in an investment account or in QYLD or anything like that. An emergency fund should actually be in a very boring bank savings account because you need to be able to access that money on demand and not have to sell out of positions and things like that. Keep in mind what we just talked about with taxes too. It gets very confusing. Keep your emergency fund aside, but if you have some extra cash that you need to park, QYLD might be a great opportunity to do that. But here's the deal. Growth is what you're going to give up as a result of the income. Sure, you might get a nice 12% dividend yield. What about the potential of potentially growing thousands upon thousands of dollars in something as strong as the NASDAQ 100? This is where I think you need to do a little bit of your own research and understand what is your goal in your investment portfolio. You never want to put all of your eggs into one basket. I would never put my entire portfolio into QYLD or anything for that matter. You got to spread it around. But if you check out this chart and we compare QYLD versus the S&P 500, well, you can see that QYLD is obviously underperforming. But I'm not saying QYLD is crap, but so many people misunderstand this ETF, and that's why I'm trying to make some sense out of this. The goal is to take advantage of the higher premiums of innovation stocks within the NASDAQ 100 index so they can pass along predictable income to the shareholders in the form of dividends. QYLD is all about the income, whereas QQQ is all about the growth of these innovation companies. So you get out to decide. Maybe you balance that out, or maybe you want more than the other. That's something that you need to look into. But is there an alternative ETF where you could get a taste of QQQ with the high growth of the NASDAQ 100 and QYLD, which has some nice monthly income? Oh yes, there is. Enter QYLG. Yes, QYLG offers to only do 50% of the covered call writing instead of 100% that QYLD does. And as a result of that, you take advantage of both the potential growth of these companies while at the same time getting a little bit of monthly income. Now, of course, because of the 50%, you're going to give up a little bit of that yield. Right now, QYLG only has a yield of a 4.61%, still pretty darn good, but that's what that is in comparison to QYLD's 12%. But your expectation on QYLG should be that it's going to have some growth over that long period of time. And if it's not performing the way you want it to, then you've got to reevaluate. Now, beyond what we talked about today, there's also NUSI. And NUSI actually has the same type of opportunity of a covered call writing strategy, but it also has a downside protection as well. So I'm going to be covering that ETF in a future video. Make sure you check that out and stay tuned because that one is coming next. What other questions do you have about QYLD? Drop them down in the comments below. Right here's a video that can help you with your ongoing personal finance journey. Here's a video YouTube thinks you're gonna like. Make sure you subscribe for more awesome content, and we'll see you on the next video.